if the dynamics of the digital economy continue to run pretty much on a market-driven basis, then we're going to have large parts of society not only left behind, but losing in absolute terms. And that's simply because the fact of job displacement by smart machines, by smart systems, by robots or by AI systems is not only a prospect, but it's happening already. And it's happening at a pretty significant rate.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Will artificial intelligence wipe out millions of the jobs done by humans today? The AI CEOs tell us it's nothing to worry about. But one of the most influential living economists, as recognized by the Economist magazine, begs to differ. He says that AI is already starting to replace human labor at scale, and we don't have a plan for the aftermath. To discuss this very important topic in depth, we've got the great privilege of speaking today with Jeffrey Sachs, professor of economics at Columbia, best-selling author, and global leader in sustainable development. Professor Sachs, thanks so much for joining us today.
It's a pleasure to be with you. Thank you.
Well, thank you. And look, you have an incredibly busy schedule. We don't have a ton of time today. I've got a lot of questions for you. We're going to get through as many as we can, and that'll be it. It's been a little while since you've been on the program, and so just to kind of level set, I want to ask you a general question. What is your current assessment of the economy, both domestically and globally right now? We can get into the details, but at a high level.
Sure. Basically, things are very uneven within the US economy and globally. By that I mean we clearly have areas of remarkable dynamism in the US around the data centers and AI. This is a boom. It's a lot of capital is being raised and a lot of capital is being invested. This is generating growth in certain parts of the economy, certain regions, certain sectors, including the power grid, which is needed for the big expansion of all of this compute. Globally, we also have many parts of the world that are very dynamic, especially in Asia. But in the United States and in the world, there are also significant sectors and parts of society that are suffering. Clearly, just basic wage income is struggling. The so-called affordability crisis is really a crisis of stagnant or falling real wages. In the world as a whole, we have fast growth in East Asia and in South Asia. We have economic crisis and stagnation in other regions, a lot of Latin America, a lot of Africa. So the picture, and Europe is basically a rich and stagnant or even contracting economy. So the picture is unsettled, it's varied, it's a highly disruptive scene because of so many deep changes that are simultaneously hitting our societies. And there is therefore no one overarching reality. It depends on who you're talking about, which part of the world you're talking about, which sectors one is talking about. What we have is uncertainty and great variation.
Okay. I was going to do this big top-down international, down more into the micro US thing, but I'm going to pull up one of my questions from the end of my list here. So, mixed, uneven, as you said. A lot of people are saying, K-shaped economy, at least, here in the US. What is your outlook for that chasm of unevenness here? Especially because so much of the hopes of the future of the US economy are being pinned on the hyperscalers. on AI. I think the last time you were on, we very briefly touched on both the promise of AI, but also some of the risks, and a big risk being massive jobs displacement and creation of a large societal under/unemployment crisis. Um, are you feeling more hopeful at this point in time that the prosperity that we're gunning for will kind of lift all boats here in the US, or are you more concerned that it actually might leave that bottom half of the K, which really feels more like 80%, 20% is the up half of the K, 80% is the down? Like, is that 80% going to get left further behind here?
Well, I think we need to distinguish two things. If you ask, will market forces solve this problem? The answer is almost certainly no. If the dynamics of the digital economy continue to run pretty much on a market-driven basis, then we're going to have large parts of society not only left behind, but losing in absolute terms. And that's simply because the fact of job displacement by smart machines, by smart systems, by robots or by AI systems is not only a prospect, but it's happening already. And it's happening at a pretty significant rate. And what we're hearing is that many sectors of the economy, including a lot of skilled worker sectors, college educated work, uh, is now already finding that there are job freezes and so on. If you ask a different question, which is taking into account politics and redistribution of income and reorganization of society, could this technology lift all boats in uh, at the end of the day? I think the logic says yes. This could be a kind of breakthrough that is very, very broadly beneficial. Then you have to ask a third question. Are our politics on track right now to fulfill that role of underpinning a broad-based benefit of AI? And the answer certainly is no. Our politics are completely dysfunctional and becoming more and more dysfunctional. There's not even a rhetorical flourish in US politics right now aimed in the right direction. No one's asking the question, uh, in Washington, I mean, what do we do to ensure broad-based development? We're in a scramble for wealth. We're in a completely corrupt political environment of self-dealing all over the place, including the president's family and everybody else involved. So our politics are not aimed at the broader benefits, and the market dynamics, which will therefore prevail in the next few years, are going to be widening the income and wealth inequalities dramatically. Look, we have 10 people in the United States whose net worth right now is $2.3 trillion. This is incredible, really. That's a lot of money. An average of $230 billion for the 10 richest Americans. Those are all big tech uh, uh, super wealth holders. Um, they not only control that wealth and the companies, but they control their platforms, the media. They have all our data, and they control the White House and the Congress to a large extent. And they're absolutely not interested in the question of how to make sure that everybody benefits from all of this. They're scrambling in competition with each other. They want to have trillion-dollar paychecks. It's a very bizarre world where we don't know whether that upper part of the K is 10 people Is 1%, is 5%? It sure is not a majority of the public.
Okay, I've been actually using the term a lowercase I-shape economy that I think we're in the danger of moving to, where it's just this little dot at the top, very few people doing extremely well, far removed from the rest of everybody who's just getting left increasingly behind. Okay, so you are, I think, safe to say, concerned about the current trajectory here, and I want to continue tugging at the string real
Yes.
quick. Um, I'd just like to get your opinion on, yes, there's a big market opportunity that the hyperscalers are rushing after, but there also is a sovereign national interest that's been declared in AI, sort of akin to the nuclear arms race back in the 30s and 40s, where America is I believe, saying, look, we've got to win this. This is going to be the technology that lets America remain the superpower of the future. If we lose this race, say to China, that could dislodge us. Um, A, is that a fair characterization? And B, do you agree with that? In other words, we'll talk for in a moment about kind of the repercussions of all this, but do we need to win the AI race as America?
Well, I think the analogy to nuclear arms is correct, and but that shows the fallacy of the claim that is made that we, quote, need to win this race. Who's the winner of the nuclear arms race? Nobody. We live under the nuclear sword of Damocles. We're at the edge of extinction. One wrong move, one mistake, everything ends. And believe me, if people think that's absurd hyperbole, they don't know what they're talking about. We live so close to the edge right now. We depend on not very smart people to keep the world alive.
Mhm.
We depend on there not being a terrible accident. Now, it's interesting to go back to the atomic bomb and the beliefs in it. When the atomic bomb was first exploded at Los Alamos, New Mexico, uh, and then used twice against Japan for no necessary reason, by the way, because the Japanese were trying to surrender at the time. But when it was used, American strategists believed that the US would have a monopoly on atomic bombs for at least a generation. They talked about 30 years. It
Mhm.
turned out to be 4 years. Uh, every calculation was a wrong calculation. When pushed by Teller, uh, we moved to thermonuclear weapons. We thought that that would be a lasting advantage. The Soviet Union matched us almost instantaneously in the hydrogen bomb. Then came the rapid proliferation of these weapons. Then came a rather desperate attempt led by President John F. Kennedy uh, initially to try to get this under control, starting with the 1963 Partial Nuclear Test Ban Treaty, and then the Nuclear Non-Proliferation Treaty, then a series of arms control agreements between the United States and the Soviet Union. Uh, and in other words, the idea of American officials was, we'll win this race. And then they realized, no, there are no winners. We are going to get ourselves blown up if we don't get this under some kind of mutual control. Uh, by the time there has been some control, there are nine nuclear countries right now, and nothing's really under control, I would say. Our situation is extraordinarily fragile. The Bulletin of Atomic Scientists puts out the doomsday clock, which is the visual representation of how close we are to disaster. And the doomsday clock is set at 89 seconds to midnight, meaning the closest we've ever been in the whole atomic age or nuclear age to nuclear Armageddon. So now to come to AI, what you expressed is absolutely the view in Washington. And I happened to listen a few years ago to a chillingly stupid discussion of two NATO generals at one of these strategic conferences that I attended once in a while. And they were saying to each other, yes, we must win the AI race with China. We're going to win. We're going to do this. Uh, this is so naive. China produces so many more PhDs than we do. Just the scale difference is vast. The talent is enormous. And you get advances in the US and then something we never heard of before called DeepSeek comes along and says,
Hmm.
we're here. And then suddenly you have all over China, top flight, top performing LLMs. And then the United States says, oh, we've got a chokehold on 2 nanometer chips, on NVIDIA chips. And then you get almost weekly a report of some new computer architecture that does an end run around those chips. The United States has some monopoly on this. Are you kidding? This is ridiculous. Of course it doesn't. Are we going to win the AI race against China? No. Are we going to lose the AI race? No. This is not that kind of thing. This is not, you know, this is not a race. This is a core technology in which there's going to be a lot of expertise all over the world. The idea that we're going to have some chokehold over this is absurd. So let's get it out of our heads at the beginning. And then we should ask, so given the analogy with nuclear arms, where is this dangerous? What should we do about it? And what should we do diplomatically about it? We should move more quickly to that. With the nuclear arms, we did not get to even the first treaty, the Partial Nuclear Test Ban Treaty, until 18 years
Hmm.
into the atomic age. Can we do a little bit better than that this time? That's what I hope.
Okay. Well, I'll add my hopes to that. The reason why I asked the question, I think you answered it, is while you and I have that hope right now, it doesn't seem that that's at the forefront of the mind of the folks in Washington, right? So,
Not at all.
right. So we have these sort of twin engines propelling the AI build out, both the market, the size of the market opportunity. So the capitalists are sprinting after that. And then the state sector is saying, look, we're going to do everything we can to clear the playing field for you because we want to win, right?
And
So,
and I would add one more very
yeah.
obvious and specific point, which is that it's not that we want to win the economic race. It is that the Pentagon is salivating. We need AI in all our weapon systems. So
Right.
this is becoming completely a national security tool as well, or what they call national security. I would call it national insecurity, because everything we are doing is raising our insecurity. But this is an extraordinary technology because it is at once everything about the production processes of the economy. So AI is becoming embedded in all production processes. It's embedded in the service economy. It's embedded in our online lives automatically. Uh, but it's also it's embedded in our media, which happens to be owned by these very platforms, whether it's Meta or Google or
Hmm.
Microsoft. So they own the media, they own the platforms. It is mortgaging our privacy because they actually own our keystrokes also in ways that I can't really understand, but I know it's there quite obviously. Um, and it's also, they own the White House. They appoint they appointed the vice president, for God's sake. They told Donald Trump who his vice president was going to be at a dinner in San Francisco. Uh, it's not even subtle, this stuff. So they own the politics. And unlike the nuclear arms, by the way, where basically, in a way, the generals just pushed away the atomic scientists after a while, or hired some of them, uh, but said, we own this. Uh, the Pentagon doesn't own AI. This is owned by Peter Thiel and Elon Musk. The Pentagon is contracting out to these companies which hold the technology now. So this is really an extraordinary concentration of private power. And you add in, yes, they're making way for all of this. Um, uh, but they're basically turning over politics, national security, mass media, the payment system, by the way, which is going to be a digital crypto something or other payment system that maybe they'll let us know about at some point, and all of our media. So
Right.
pretty
They're
pretty
putting it into
unusual.
the hands of private jets. It's almost sort of
Yes.
the Tony Starkization of the economy, if you get the reference from the Marvel movies.
Yes.
Okay, again, I think you're proving the point I'm trying to make here, which is this is a juggernaut that is in motion and perhaps even still building momentum. So, as much as you and I would like there to be more cautionary, steps in here, probably not going to happen anytime soon. Which gets us to okay, so probably doesn't bode pretty well for that bottom 80%, right? Like we might get cheaper entertainment. Okay, hooray! Maybe we enter the Ready Player One era where we get free VR goggles and we can spend all our time in the virtual world. But we're out of jobs. We're out of purpose. We're out of power on a relative basis because it's concentrating in that dot of the lowercase die-shaped economy that we talked about. So I guess a lot of concerns around that. Now, you had said there's a way to do it differently. And I guess first I just want to imprint on the listeners that a really smart gentleman like yourself, who's very connected and studies all this stuff, is quite worried about where society could go here. And maybe I might ask you just to make a comment or two on what you think that future looks like, where the bottom 80% get even further dispossessed from here. And then secondly, I'd like you to talk about your vision of how we could do it differently. And I guess where I'm going with this is what I hear from the AI fanboys is, hey, AI is going to create a lot of jobs as well. Maybe, but I think on a fractional basis, it's going to be a lot fewer than it's displacing. So they say, well, even if it does, we'll have universal basic income and everybody can go focus on being their best selves. I think history is pretty clear. It's my opinion. You might feel differently that giving people a subsidy to basically do nothing creates a dependent class that ends up investing more in their vices than their virtues. So in the better way we do this, if technology is still doing all the work, how do we make this more equal? Is it just redistributive policies, or is there something in here that gives the bottom 80% a role?
Well, first of all, I don't know the answers to this, and I don't think anybody does. I haven't seen or
Right.
heard anything that I find accurate and compelling that says that is how the future will play out. So I just want to caution on that obvious point at the beginning. Second, we've been in the midst of related changes for at least uh, 60 years. Uh, Automation became a thing, a noticeable thing in the 1960s.
Mhm.
It became a matter of a lot of public discussion already 60 years ago. And that was not wrong to worry about that because what we've had during a 60-year period is a bifurcation of society into three parts now. One is the the super uber haves,
Hmm.
those who have more than is absolutely imaginable. And then the successful haves, which is broadly speaking, the professional class in America, typically people who have had an advanced degree of some kind, an MBA or law degree or medical degree or other professional degree. And the broadly speaking, somewhere between the high school completion and bachelor's completion, depending on a lot of specifics, but finding stagnant wages by and large, and very big difficulties of accumulating wealth. Uh, and one of the most evident of those difficulties is homeowning for young people, which
Hmm.
is deemed to be a pretty widespread crisis for a lot of young people. So we've already trifurcated, you could say. We already have three different groupings in society that live very, very different lives. If you ask my cohort in the professional world, how are things and how they've been over the last 20 years? Yeah, good, very good. Good incomes. Stock market's been going up. Lots of new opportunities. Tech has been good. Feels all very good, actually.
My house
If
goes up in value every year.
Yeah,
Yeah.
if you ask someone who basically doesn't have saving and if they've been very unlucky, but that's a lot of American people aged 25 to 50, um, had a high school degree, went to work, lost their job, and so forth. This is not easy. Healthcare costs are soaring, hard to save anything. What's called the affordability crisis is really, again, a stagnant wages crisis that comes from the fact that basic jobs have been under uh, replacement dynamics for decades, not just now. It's not just AI, it's robots, it's smart systems of many kinds that have been
Hmm.
operating. So we're already in the midst of this. What is interesting is that and it showed up in some, everybody understands this now, I hope, in some very dramatic ways, life expectancy gaps between having a university education and a high school education is 8 or 10 years of life expectancy. Can you imagine this? Completely different lives within our society. And what is interesting, it's a strange word, but if you're an analyst, our political system to this day hasn't reacted to this. Uh, Really, we have been in a kind of paralysis. We had, for example, a huge fight over Obamacare. Obamacare is a half of 1% of GDP. It's a tiny little change of the national income. It was, full out war for a decade in the political system. In other words, our political system is paralyzed, unable to address big issues like the changing income distribution according to educational attainment. And now we have a different changing income distribution. It's not really most likely between skilled and unskilled or high educated and lower educated. It's actually more broadly between those who have financial wealth and those who don't. Because stock market has, maybe there's some bubble in it, but it's been booming in part because more and more national income goes to profits, goes to the returns to patents, goes to software, goes to the monopoly or oligopoly ownership of a few digital platforms. And if you happen to have enough income that you have been saving out of that income and you've been investing in your in your retirement accounts and so forth, you've been a beneficiary of that wealth. But if your income has been so low that you're, my God, still trying to pay your student debt or trying to pay an unexpected healthcare emergency, you don't have wealth. You haven't benefited from the shift of national income from wages to profits. You've lost from that. And so we are now in an intensifying phase of this growing inequality. And I don't see the slightest evidence at all, no evidence right now, that Washington's on the case. I don't hear one word about it. I don't hear even a conceptualization. The Democrats, I mean, it's stupid even to say they don't represent, they don't represent the workers, but MAGA doesn't represent the workers either. The whole thing is shambolic. Both of them, Democrats, if they represent any class, they represent professionals. And MAGA represents the Trump family and his friends. And so we don't have a politics of facing up to this question. We have no serious discussion. We don't even get to your question of is there a better way than redistribution or pre-distribution to address this? I'm pretty sure, by the way, that part of the answer is actually what we would call pre-distribution, which is that at least everybody gets education with quality and healthcare with quality, not out of their personal consumption spending, but out of their citizenship. I do think that this is absolutely right, that we have, as a matter of citizenship, that you can get your health care without needing a MD or PhD to understand our healthcare system, and without having to, go into irreversible indebtedness to pay your medical bills. But we're not even there at that point yet.
Okay, Professor Sachs, I have so many questions for you, but we're running out of time, so we'll just have to reserve them for the next time. To kind of land the plane here, I hear you say, look, problem's big, maybe intractable. Our
No, I
political
don't say
system.
intractable.
Well, you
I
didn't
just
say
say
okay,
big,
yeah,
big,
yeah,
big,
okay,
big.
but very, very big. Say in the near term, it might feel intractable, and our political system is not going to ride to the rescue anytime soon.
Our
So,
political system, as it's now constituted, yes,
as it's now constituted, yes.
yes.
So, I mean, there's so many questions that the audience would like me to ask you here, but just to make it practical, for somebody watching this who is saying, whoa, this feels really heavy and kind of depressing, do you have any advice to them to at least say, look, here are some things you could think about considering so that you are less likely, you're reducing your odds of being collateral damage to all of this if this juggernaut continues for the next 5 to 10 years?
Yeah, let me just say in the long picture, which is not a very satisfactory answer, but it's also important to understand this is not a new phenomenon in some fundamental way because big technological breakthroughs have not only expanded the pie, but have repeatedly uh, reshaped the distribution of income, usually in an unequal way at the beginning. So I just want to make the following point. When the
Like
industrial,
the railroads, good example,
yes,
right? Maybe we had the robber barons, but then everybody
exactly.
benefited. Yeah.
When we had the Industrial Revolution in the 19th century, uh, the first half of the 19th century was very tough for those who were found themselves in grim Dickensian circumstances in the new factory towns. It was miserable. And that's what gave rise to the Communist Manifesto in 1848 and gave rise to the idea that there needs to be a proletarian revolution and so forth. 50 years on, it took a long time, but there started to be a more general rise of well-being, partly from market forces, but a lot through politics, what we call the populist movement and then the progressive movement, and the reforms that came with that. And then the culmination of that in the United States was the New Deal under Franklin Roosevelt. And that brought in Social Security and many other broad-based measures to say we need to share this growing bounty. And of course, FDR talked about 1/3 of our nation ill-fed, ill-clothed, ill-housed, and that the U.S. was a rich country with a lot of poverty, and we should do something about it. And my view is FDR was our greatest president in our country's history for taking this on, as well as for many other things that he accomplished. So politics did come through in the end, and the basic idea, you have a larger pie. If politics works, everyone can be better off. I want to say that that is a logic also that applies to these new technologies. I really like them. I think they're incredible. I think that they raise productivity. I think that they do all sorts of good things. I despair of our corrupted political system, our corrupted politicians, our corrupted chief executive. This is not how our country should be. It's not intrinsic to the technology, is what I'm saying. We can get to these reforms. At some point, our country will figure out, it really will figure out, it's not right to have someone asking for $1 trillion paycheck. That's just not right, Elon. It's not right having 10 people who have $2.3 trillion of wealth. An interesting part of the politics is the concentration of wealth and power is so extreme that actually the vote is overwhelmingly against them. You don't have to be the median voter. You have to be, like you said, in the 80th percentile or the 90th percentile to say, to hell with this, come on. And so this gives me some optimism that some political entrepreneur is going to wake up and say, look, why do we all feel poor when we're in a booming technology? Well, it's because it's all going to those few people who think that they own the shop. And then we could actually start to get some real reform. So I find it distressing and disturbing watching our politics. I find it really shambolic. But I'm not completely pessimistic because if it's just 10 of them, well, we're 350 million. We ought to be able to figure that one out.
Right. We outnumber them. Yeah.
Yes.
And that's good to end on. So you're saying, look, while it may feel dire, and it might be dire for a while, maybe even a good while, you don't think it's the end of the American experiment? We've been through technological cycles like this in the past. I will note the one question I didn't raise in here, which we won't inject in the conversation, but it's just, yeah, but provided AI doesn't kill us all, at some point in here, the Terminator, risk here, but that's a discussion for a different day. Professor Sachs, I very much appreciate you doing this, especially under such a tight schedule. Very enlightening, sobering, but important conversation. Really appreciate you having it just out in the open like this. Last question for you. For folks that would like to follow you and your work in between now and your next appearance on this channel, where should they go?
Oh, thanks a lot. I have a website called jeffsachs.org. Please do that. Every day there are deep or not even so deep fakes of me all over all over the websites right now because this is another part of AI. I'm hearing all sorts of things about speeches I never gave and so forth. So if you want the real thing,
stuff,
it's at jeffsachs.org.
Fantastic. And when I edit this, I will put that up on the screen so
Excellent.
Folks know exactly where to go. Folks, the link will be in the description below the video as well. All right. And lastly, folks, please join me in thanking Professor Sachs for giving so much of himself and the time that he had here to us. I extend that thanks by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And if, he gave us an awful lot of food for thought here. If you would like some professional help from a professional financial advisor on trying to think through the repercussions of the direction of the AI juggernaut, what that might mean for your portfolio, ways to perhaps maybe take advantage of it to, if there's going to be a winning team in the near term, at least make sure you're on it, and also make sure that the other parts of your investment might be better insulated from some of the risks. Then if you don't have a good professional financial advisor already advising you on all that, feel free to talk to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule a free consultation with them, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. Again, these discussions are totally free. There's no commitments involved. It's just a service they offer to be as helpful to as many people as possible. Professor Sachs, again, I cannot thank you enough for giving so much of yourself to such an important topic, talking about it so frankly, and giving us so much in the limited time that you have. Really appreciate you making the time for this audience.
Great to be with you. See you again soon.
I think gold is going much, much higher. Yep. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I don't disagree with that. And as I just said, $35,000 per ounce, I mean, that's the highest number we have heard of gold today, right? That's my target. But what I'm saying is that does not rule out a 40% decline into a deflationary bust where the Dixie can go to 122.
You can't get rate cuts without some aggressive buying of the bond market. Who's going to rush in and buy all the US issued bonds in an aggressive way that it pushes prices up immensely, sufficiently for you to have that dip in rates that's going to lead to a 40% correction in gold?
The speaker, Henrik Seeberg, along with Francis Hunt, projects gold soaring to around $35,000 by the early 2030s, calling it their long-term target, yet warns this doesn't rule out a sharp correction along the way. They caution that a deflationary bust, driven by a surging dollar index possibly reaching 122, could trigger as much as a 40% decline in gold before the next leg higher. With current rate cut expectations and without massive, aggressive bond buying to push yields lower, they question who will step in to absorb U.S. debt, suggesting that such market stress could create the conditions for gold's temporary collapse before its eventual climb to historic highs. Francis Hunt, the market sniper, in discussion with Henrik Seeberg and Matthew Piepenburg, noted that while some foresee a 30 to 40% correction in gold during the next crisis, such a dip would be a buying opportunity. They argue a deep collapse is unlikely since today's rally is fueled by central banks like China and Russia, not just retail investors. Even a 15 to 20% drop would likely see these nations selling treasuries to buy more gold. Still, Henrik and Matthew caution that a strong dollar spike could trigger a meaningful pullback in a deflationary bust. Henrik Seeberg, a macroeconomist, trader, and financial strategist, countered that forced selling could still drive gold lower, whether from hedge funds in trouble, leveraged retail traders, or even stressed sovereigns liquidating reserves. Matthew Piepenburg, macro strategist, author, and investor, highlights that in such moments, liquidity needs dominate, and because debt is denominated in dollars, gold often gets sold to raise cash quickly, just as in 2008. Yet unlike that crisis, today's backdrop is very different. Central banks, the BIS, and even discussions in the U.S. point to gold's growing role in the financial system, with BRICS nations using it for settlement in trade and oil deals. This stronger structural demand suggests that while short-term volatility and corrections may occur, the long-term trajectory for gold remains firmly upward. We're about to explore the video, but first, subscribe and hit the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
What Henrik is saying is valid. For me, again, I'm still agnostic because I started buying gold 20 years ago. If we have a 40-30% dip in the next market crisis, I'm relatively using that as a buying opportunity. But smugly,
but hold on, you have the notion that we'd have a 40% drop in gold. What do you think?
I don't think we will. I don't think we will. But we have to. What's that?
What is China? The gold is running not because of you and I. It's running because of central bankers.
That's my view too, Francis. I agree.
If the treasury market is doing, and the dollar is doing what Henrik is saying, and you're having a 40% drop in gold, if you even just get to a 20% or a 15%, what do you think China and Russia are doing with any dollars or treasuries they hold? That's amazing. Thank you for the liquidity. Have it all back. These guys, China is a patience trader. They are not a trader. They're a patience investor. They sleep on the riverbank and wait for the dead bodies of their enemies to come by. That's
why I think it's ultimately...
That will absolutely unload everything into wherever
I agree.
the sudden liquidity is coming from. So how do you get a 40% collapse with all the major central banks, probably including Switzerland, which is supposed to be a friend, but was also been accumulating gold? Every major central bank, which is the key move the needle gold buyer, on a 40% drop. So we're at 3,300. You're talking 1,700, 1,800. Great. They're going to load up and they're going to get rid of all those treasuries. They'll be doing it long before you get that 40%. And I
don't think it tops yet. I think it has a little more a higher move than before we top, but I think the top is in around 3,700 or something like that. And then I think you're going to see with the Dixie spiking up like that, you're going to see a very large decline. And again, into a deflationary bust like what we could see here, everything is overvalued. We agree on that. Everything is overvalued.
Who's selling the gold and who's buying the treasuries?
But it's not. It will be about. Because you'll also have a situation potentially where there will be, you had a situation also where gold actually dropped because there was at least the rumors said there was a hedge fund, in problems and they had to go sell gold and you saw a large decline in that gold. I can't remember when it was not so long ago. So things can happen. If the floor opens up and a lot of people are starting to lose their money on their crazy crypto investments or whatever it's going to be, or their hedged long
that's retail.
Leveraged.
That's not central. No,
but this is good. This is good. This is good because it's important to have a disagreement on the DXY. We agree on gold.
What we're actually saying is crypto kiddies that are losing money on crypto, who happen to be big gold holders, are now going to be selling their gold, and they're going to crash the gold market in an environment where the central bank
it can also be sovereign nations that can be in problem. Can get a problem if you start to see that they're the yields levels.
But Henrik, are you saying that in this event where the Dixie spikes in this short-term window of shit happens? Excuse my French. Is that going to be driven more by a need to sell gold for liquidity, or driven more by a need to buy U.S. treasuries as U.S. dollars for safety in that moment?
I don't think there's either or. I think there's there'll be a plethora of things. I think it'll be driven by the need for liquidity, and the only real liquidity is where the debt is denominated in, and that will be denominated in dollars. You can't pay off your debt with gold. You need to sell gold. And the thing with gold is that it's fantastic to give you liquidity when you need it, and that's what it's there for. So you'll probably see that the sell-off will be something that will be forced.
What happened in 2008? I'm just trying to find.
Arguably, which is the 35%
but
decline.
Unlike 2008, I'm just trying to. I'm not saying this isn't a foolish argument.
No, that's fine. We just
unlike 2008 though. Today in 2025, the mood, the need, and the status of gold, not just in the headlines, but literally at the BIS, literally at the Fed, even all this nonsense and discussion about gold-backed U.S. dollar again, and not to mention revaluation, not even going down those rabbit holes. What we're seeing with the use of BRICS gold as a trade settlement for net settling, what we're seeing in the oil trade, what we're seeing with the stacking of physical gold in the East, don't you think the environment from the BIS to the Shanghai Exchange to the SPIMEX in St. Petersburg is so different now than in 2008?
Henrik suggests gold isn't in a bubble, but simply preserving value as fiat currencies weaken. Its rise may reflect a fiat bear market rather than overvaluation. Silver, platinum, and miners lag behind. Some argue gold has front-run inflation fears and could pull back if the dollar spikes, like in 2008. Others note it hasn't reached inflation-adjusted 1980 highs, and with record global debt, gold's long-term fundamentals remain strong. The broader view is that gold has solid fundamentals, unlike Bitcoin, which some describe as a bubble driven by speculation. Gold is backed by decades of central bank demand and its historic role as real money. Analysts like Francis, Matthew, and Henrik collectively highlight patterns where gold has outperformed stocks after major crises, comparing today's setup to 1929, 1971, and 2000. While a deflationary bust could temporarily make the dollar everything, forcing some gold liquidation to cover debts, the longer-term trend still points to dramatic gains. With projections as high as $35,000 by the early 2030s, gold's role as a hedge against excessive debt and fiat debasement seems more relevant than ever. Now, let's get back to the interview.
What if gold is not in a bubble at all? What if gold is simply doing what gold does best, and the only thing that's in a bubble is the US dollar or the yuan or the yen?
Somebody should have told platinum, silver, and GDX.
I think the GDX, I think platinum, platinum's another conversation. I think silver always is the little speedboat that can once gold hits a bull market, but gold isn't in a bull market yet. That's why silver hasn't taken off.
But I think silver actually looks even worse than that. And we also know that normally when we have a real bull market, we'll see silver follow. Silver is not at all-time highs yet. And there's nobody who can tell me technically that this looks strong for silver.
Early stage.
No. This is actually late stage. This is late stage if you look technically. You have that the silver is making lower highs on a weekly basis when it moves higher. That tells us that you're moving into a level where it's probably, and I'm saying it's around 41, 40 something, 42 maybe.
Yeah, but that's
where
a
you're going to see
point.
a decline.
I also see silver being rejected in the 40s before running 50.
But this is actually a very big rejection. And it just doesn't make sense. It doesn't make sense. It doesn't make sense but gold should just keep moving higher. And silver, by the way, gets rejected at levels which are far lower than the all-time highs. And by the way, minus does the same, and so does platinum. So what if the most rational explanation is actually that gold has been front-running things a little here because everybody's been talking about inflation and how that is a problem, and that is a problem.
Devalued. It's artificially devalued.
And that is why it's going to have a relative larger pullback when the Dixie is going to, when we go through this whole shit.
There's an industrial component to silver, number one. And
that's my perspective.
I get your perspective, Henrik.
That's my perspective.
And hyperstagflation, there's an industrial component.
We're not stagflation now. We 2.7%, there's no stagflation.
We are absolutely not getting consumer buying. So there's not the same.
But we have 2.7% inflation. We have 2.7% inflation. That is low historically.
You've been
very, very low.
A number of 2%.
But you don't actually believe that's the real inflation number. And silver priced in gold terms is still very cheap, as is platinum. And technicals, you guys are far better than me, but we're at a 45-year cup and handle for silver. I think silver's just waiting for gold to actually have a bull market. I don't think it's a bull market. Gold is kind of itself in a bull market, maybe a little bit inflated, hype, front running, and that the real, and I'm simplifying that, when there's a real moment, that there'll be an 08-like sell-off because 2025 is very similar to 08. I would argue it's different. But if you were to change your thesis just a little bit, if you could think of, and maybe you don't, that it's not that gold is in any kind of a bull market. If anything, gold is doing what it always does, which is nothing. It just sits there. Well, fiat money is very busy and sovereign debt is very busy debasing fiat money. And what we have is a major, I think, fiat bear market, and a bull market for gold is simply waiting for the fiat to die.
That we agree on.
But you don't think there's a difference in degree? You still think the gold is overvalued given the level of U.S. or global debt? You still think it's overvalued?
No. I think, as I said also, I think gold is going much, much higher. Yep. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I just want to say, like when I'm talking to Bitcoin guys also, I'm saying, guys, I know the saying of institutional adaptation and all these things, but by the end of the day, I think it's a bubble. Okay. And I think that's the way it is. What I see with gold is that I think gold has a fundamental and it's going to also, if I look at Bitcoin gold actually ratio, you can also see that there is something to that. Bitcoin was outperforming a little more, and then you're going to see gold actually taking over again. If you look to the SPX versus gold, you can also see that we have a similar situation like what we had in 1929, in 2000, and in 2000 actually, and also 1971. Sorry, also with Nixon. So we have a unique situation here where yes, gold is going to outperform in the longer time frame. That is if you take the dollar out of the equation. But that's not what you can do in a deflationary bust, because that is when the dollar is everything. The dollar is everything, because you need to pay your debt. So if I get it right,
when you say the dollar is everything, you're saying the debt instrument is everything too. You've got to talk about both. Who's buying the debt? Yeah, this is the gold bubble, apparently, according to you, at the moment. How can you? I don't see how technically you can say that. We haven't even reached 2000. The 1980s
No, I'm not.
This is adjusted for the fake statistics that you like. The BLS, these are their stats, dividing by the CPI. And that's where you are. You haven't even met the CPI adjusted high of 1980. And we are in 130% of debt in the United States, 39 trillion, where we were compared to in 1980.
While short-term volatility and even sharp corrections in gold remain possible during a deflationary bust, the long-term outlook remains overwhelmingly bullish. Central bank accumulation, rising debt burdens, and fiat currency weakness all reinforce gold's role as a core store of value. Whether or not interim sell-offs occur, the trajectory toward dramatically higher levels, potentially $35,000 by the early 2030s, reflects gold's enduring importance in an increasingly unstable financial system. If central banks continue to buy aggressively, could they prevent any major gold correction despite a dollar spike? How might silver and other precious metals respond once gold officially enters its next major bull phase? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.
If a group of paper gold investors suddenly demands physical delivery, the counterparties will have to buy gold in the spot market since the leased gold is not in their possession. The gold market is liquid, but not liquid enough to support delivery if there were demand for more physical than a small slice of the paper gold market. A full-scale gold panic would quickly emerge. The spot gold price would go to $25,000 per ounce before an investor could yell buy. I take it that someone, possibly Scott Bessent, sat down and potentially explained the paper gold reality to Trump and Musk. Once you understand how the gold market actually works, you quickly back away from putting on a show at Fort Knox.
If paper gold investors suddenly demanded real delivery, the system would collapse fast. Since leased gold isn't actually in their possession, counterparties would be forced to scramble for metal in the spot market, but there isn't nearly enough physical gold available to cover more than a fraction of paper claims. That kind of rush would trigger a panic, with prices shooting toward $25,000 an ounce almost instantly. It's likely someone, maybe Scott Bent, explained this fragile reality to Trump and Musk, which is why they backed away from the idea of making a public spectacle at Fort Knox. Mike Maloney, best-selling author of Guide to Investing in Gold and Silver and founder of goldsilver.com, reveals that China has just issued a groundbreaking mandate requiring its largest insurance companies to allocate 1% of their assets into physical gold. This rule is being funded by reducing U.S. Treasury holdings, accelerating China's shift away from the dollar, and creating massive new demand in the gold market. At current prices, this would consume 15 to 20% of annual global mine production, an amount so large that it virtually guarantees upward pressure on prices. With mine supply stagnant, this structural demand could push gold far above its current record highs in the years ahead. Meanwhile, momentum is building elsewhere. India's pension regulator is considering allowing retirement funds to invest in gold ETFs. Indonesia is weighing limits on gold exports to preserve reserves, and Florida has legalized gold and silver for transactions. Mike Maloney, at the same time, also highlights that Japan's collapsing yen has driven gold to record highs there, tripling in value over the past 5 years. Globally, gold still represents just 0.5% of financial assets compared to a long-term average of 2%. Even a simple return to historical norms would multiply demand several times over, signaling the early stages of a potential gold supercycle. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
Physical gold mandate for insurance companies will reshape the world's gold market. So Avery Goodman, and this is also, this is just a few days old actually. So, a couple of weeks. China's insurance regulator now requires major insurers to allocate 1% of their assets to physical gold, creating unprecedented structural demand. This move is explicitly funded by reducing U.S. Treasury holdings, accelerating China's de-dollarization, and shifting global gold market dynamics. The mandated gold buying at current prices will absorb about 15 to 20% of annual global mine supply. 15 to 20% of annual global mine supply, supporting a significant price increase due to limited new supply. Yes, it would. This percentage will get smaller as price goes up. Given stagnant mine output and rising institutional demand, gold prices are likely to rise significantly above current historic highs in the coming years. Absolutely. If this demand that is mandated, that insurance companies do this, right now it's 15 to 20% at these prices. But this is like an impossible situation. The prices have to rise for that 1% of their yuan-denominated assets to be allocated toward gold. Moving on, Eric Jung, Indian pension funds might invest in gold. And this is from Bloomberg. India's pension regulator is considering easing investment restrictions after portfolio managers pushed for new ways to boost returns on a rapidly growing pool of retirement money. It's not money. This is currency, and they're trying to turn it into money, according to people familiar with the matter. Retirement fund managers met senior officials from the Pension Fund Regulatory and Development Authority in a series of meetings late last month and requested permission to invest in gold ETFs. I wish they would just invest in physical gold, the people said, asking not to be named, and so on. The regulators are considering the proposal and have sent the draft language on gold investments to the funds for feedback. So this is something that is potentially happening, and it's big. Moving on, holy smokes, Eric Jung again, Indonesia looking at reducing gold exports to keep the strategic reserve currency within its own borders. This isn't currency. This is strategic reserve money, and it's the only money. They've got a whole bunch of other fiat currencies as reserves. But this is the only money that they hold, but they want to keep it within their own borders. And this, again, is from Bloomberg. So very legitimate stuff. This is old. This was May 27th, but, Florida signed a bill into a law allowing people to make transactions using gold and silver. So gold and silver is being remonetized. I mean, nobody's doing it yet. Do you have to make them at face value on the coins of $1 for a silver eagle and $50 for a gold eagle, which is crazy? Or can you make them at the current spot price? That would be awesome. Here's the Ron DeSantis announcing it. Gold just broke 500,000 yen in Japan. The yen is getting torched, and gold is going vertical. Japan's debt to GDP is the worst in the developed world. Their only option, print or collapse. Either way, gold wins, and that is absolutely true. And gold in Japan has tripled since the beginning of this chart. In just the last 5 years, gold has tripled in Japan. You may have heard Rick Rule say that global allocation to gold has dropped to 0.5% in recent years, while the multi-decade average is 2%. Now, I've heard and seen measurements where gold was actually 8% of global financial assets when it was in a bubble in 1980. So a mere reversion to the mean would quadruple investment demand for gold. A reversion to a bubble like 1980 would be 16 times the investment demand. So the price would have to go astronomical. Well, here's the evidence it may be starting. Hong Kong investors triple gold holdings in rush to save haven, according to Hong Kong Shanghai Bank Corporation.
Mike points out that silver remains an extreme bargain at around $40 an ounce when compared to its inflation-adjusted 1980 high of $1,640. At the same time, questions about the accuracy of official inflation data have grown louder. Analysts like John Williams argue that government changes to CPI calculations in the early 1980s distorted the true picture of rising costs, which also explains why long-trusted financial models suddenly stopped working. Gold's steady rise since then, they say, simply confirms this hidden inflation and highlights how far the dollar has fallen since the Federal Reserve was created. Meanwhile, gold market dynamics reveal deeper cracks. The physical gold inventory has been flat or declining even as gold prices make new highs, raising suspicions that major players are quietly pulling gold out of ETFs. On the political front, Trump has floated bold ideas like issuing gold-backed treasury bonds to challenge the Fed's authority and restore confidence in the dollar. Calls to audit America's gold reserves are also resurfacing, as many now frame the issue correctly. It's not so much that gold is skyrocketing, but that the US dollar has been relentlessly devalued and is today worth just 1/3,300th of an ounce of gold. Now let's revise the interview.
Silver, look at where it sits. It is an extreme bargain at just about $40 an ounce, because the high in 1980, inflation adjusted, is $1,640. Bam. So moving on, this is John sent me these recently. This is the Consumer Price Index. This is the original one, the blue line. This is the CPI starting in 1982, where it diverged from the original CPI. And like I said, the truth lies somewhere in the middle. But when I spoke with John, he believes that gold is just corroborating his assumptions because he was an actuary and his models all stopped working after 1982. And he was trying to figure out why something that had worked for years and years and years just suddenly stopped working. And when he investigated it, it was because the government, the Bureau of Labor Statistics, started fiddling with the way that CPI is calculated. And so he also provides, this has some critical dates. The Federal Reserve, Roosevelt abandoning gold, Nixon closing the gold window, and the CPI reporting alterations started right there. And then he also publishes a much longer term chart, taking it all the way back to the colony, the U.S. colonies, the American colonies, not the U.S. didn't exist yet. 1665. And you can see what happened because of that green dot, the Federal Reserve. Something evil has transpired. Eric Young, again, GLD, gold inventory tonnage versus the gold price ratio at its lows. So this is it, and it just shows I don't trust GLD. The price is going up, the tonnage, is sort of flat. That causes the ratio to go down, meaning that the gold price is making new highs while GLD physical gold inventory is hovering at its intermediate lows. Who is sucking physical gold out of GLD? Thanks, Nick Laird, for the wonderful charts. So gold charts are us, or on X, it's Goldfish charts. Moving on, gold revaluation, Trump's red button option. And Trump eyes radical gold idea to expose the Fed and anchor the dollar. And this is about issuing gold-backed U.S. Treasury bonds. Forbes talking about the secret weapon Trump can use to take on the Fed. And he keeps on trying to take on the Fed. The logic of auditing America's gold, the measures reintroduced in Congress, is aimed to restoring confidence in a greenback, the value of which has plummeted below 1/3,300th of an ounce of gold. I'm glad that people are starting to finally state this in the proper terms, that the U.S. dollar has been devalued and is now only worth 1/3,300th of an ounce of gold. It's the dollar falling more than it is gold rising. Now, gold will rise in value during these periods of time when it's basically revaluing itself.
In short, gold and silver are no longer just safe haven assets. They're becoming central to a global financial realignment. From China's bold mandates to structural cracks in paper markets, the stage is being set for a historic revaluation of precious metals. With supply constrained and demand surging worldwide, the question isn't if prices will rise, but how fast and how far they'll go. Do you think China's gold mandate could trigger similar moves from other countries or institutions? Is silver, with its extreme undervaluation, the more explosive opportunity compared to gold in this coming cycle? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.
Central banks are making out of US dollars and out of US treasuries into gold. And that has been the primary driver of the gold bull market. And gold has outperformed the S&P so far in the 21st century, 25 years. And this is going to accelerate. And not only is it going to accelerate among central banks, but institutional investors and retail investors are going to finally start to participate. So, a $10,000 gold price is not that far off. It's only about a triple from here. But I think it could easily be done over the next, maybe 3 to 5 years.
Central banks are set for a fourth straight year of heavy gold buying, with around 1,000 metric tons expected in 2025 as they shift away from dollar assets amid U.S. policy and geopolitical risks. In Q2 2025 alone, they bought 166 tons, 41% above normal levels, showing the urgency of this move. A World Gold Council survey found 95% of reserve managers expect gold holdings to rise in the next year, with 43% planning to add more, while many see the dollar's role declining over the next 5 years in favor of gold, the euro, and the yuan. Peter Schiff is a well-known economist, investor, and financial commentator, highlights that gold miners have surged over 50%, far outpacing bullion's 25% gain, with ETFs like GDX and GDXJ still trading at low valuations despite strong earnings growth. A Reuters poll sees gold averaging $3,220 in 2025 and $3,400 in 2026. Silver is up 32% this year, nearing $40, its highest in 14 years. He mentions that the S&P may be up about 10% this year, but with the dollar down the same amount, international investors see no real gains in U.S. stocks. In contrast, this performance gap signals a shift of capital away from the U.S., as both foreign and American investors redirect money abroad. Gold and silver mining stocks have been standout performers, up nearly 80% and on pace to possibly double this year, outperforming tech, crypto, and every other sector, yet largely ignored by mainstream media. Looking ahead, while developed markets like Europe and Asia have led in 2025, emerging markets remain undervalued and could be the big story of 2026. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
Well, look, the inflation is going to erode away most of the investment returns. Yeah, the S&P 500 is up 1.5% today, but the dollar's down 1%. So, it's really only 0.5% if you measure it in other currencies, and that's how investors around the world are looking at it. But meanwhile, foreign stocks are doing a lot better. Look at gold stocks, which, gold stocks are up another 2% on the day, but they're up 77% year to date. That's the GDX and GDXJ. So this is indicative of, the Fed being too loose. And, gold is up today, but it's still, below 3,400. Silver is now back above $39. But I think silver is getting ready to blow through 40. And I think gold's getting ready to blow through 3,500. Well, the economy is not booming, and nor is it going to boom at all during the Trump years. But in order to cure the problems that he inherited and that he contributed to during the 4 years he was president, right? He doesn't come to this thing with clean hands. But in order to fix the problems, we actually need a bust, right? We need the bust before we can have the boom. Trump wants to skip the bust and go right to the boom, which you can't do. All you can have is a bubble. So rather than have a legitimate economic boom, Trump just wants to inflate another bubble so he can pretend that the economy is booming, even though we're just blowing air into a bubble.
Yeah. And so you mentioned a bust. How bad could this bust look? Like how bad could it be?
Horrific. I mean, much worse than 2008. I mean, we have a huge debt bubble, and when it pops, there's a lot of disaster in its wake. I mean, there's going to be a lot of defaults, a lot of bankruptcies, a lot of failures. Look, stocks are going to crash, bonds are going to crash, real estate's going to crash. Look, a lot of bad, painful things have to happen to fix this problem. That's why the problem's not going to get fixed, because the politicians don't have any stomach for that pain, because it might mean that they don't get reelected. And of course, that's the only pain they care about is their own pain. And so they're going to kick the can down the road with another sugar high. And the Fed is now cooperating, cutting rates. By next year, they'll be in QE mode. Yeah, well, I think the S&P is maybe up around 10% this year, which is about how much the dollar is down. So if you're an international investor, you're looking at no return on U.S. stocks. Meanwhile, I look at my mutual funds. I have 5 mutual funds. One of my mutual funds is called the Euro-Pacific International Dividend Payers Fund. And we buy dividend-paying stocks outside the United States. So, higher dividend-paying stocks. So typically, these are more conservative type stocks. So they're not growth-oriented. We're buying them because they pay good dividends. Well, that fund, year to date, is almost up 40% now. 40%. Now, yeah, about 10% of that is foreign exchange related. But still, that is, a huge performance gap. I mean, basically, we're making 4 times the money investing in foreign stocks as we would be investing in the S&P. And that is a big signal to capital allocators around the world to jump on board this train. And so I think you're going to see a lot of money leaving the U.S. markets. Money that has been sucked into the U.S. markets for the past 10, 12 years is now going to get sucked out. And that means foreigners who have U.S. investments are going to sell their U.S. investments and bring their money home. But then Americans are going to sell their U.S. investments and send their money abroad. And so that's what's really going to be helping. I mean, my asset management company, Euro Pacific Asset Management, because that's what we specialize in. And again, gold stocks are up now close to 80% on the year, 77% for the GDXJ. This is the best year on pace that I can remember. I mean, there may have been a better year in the early 1970s, mid 1970s, but this, I think, is the biggest single calendar year that I can remember on pace. Because I think we could finish the year where the GDX and GDXJ, these are indexes, double in value, 100% gain in a single year. And gold stocks year to date are the best performing sector, gold and silver mining stocks, in the U.S. stock market. They're beating tech, right? They're beating crypto. They're beating whatever. Like whatever you think is the best, it's not. It's gold and silver mining stocks. And they're getting no coverage. If you watch the mainstream financial media, you'd have no clue that these stocks were doing so well. We've been way overweight Europe. And we have investments in Southeast Asia, including Japan. And we have some money in South America and in Canada, But I think we're going to probably be allocating a little bit more into the emerging markets. We have an emerging market fund that concentrates. And the emerging market fund is my least performing fund. Year to date, it's up, in the low 20s, which is still beating the U.S. by double, more than double. But the emerging markets haven't done as well this year as the developed markets. I think that may change in 2026. So I think we're probably going to allocate a little bit more into the EM for next year, because I think that's going to be a big 2026 story, is going to be the outperformance of emerging markets, because they're still really, really cheap compared to developed markets, and even cheaper compared to the U.S. market. Well, I mean, I think silver's looking pretty strong. I mean, we're just around $39. There's obviously some resistance up there. But if we can break through it, I mean, we're not quite at a 52-week high today. We didn't quite make the highs. But we'll see what happens next week. I mean, I know that these metals are basing, but silver is very cheap. And so I've been a real promoter recently, last 6 months in particular, even before when it was 100 to 1, when silver was, when you could get 100 ounces of silver for 1 ounce of gold. And, it's not quite that cheap anymore, but it's still historically cheap. So I really like silver.
U.S. assets currently dominate global portfolios, accounting for nearly half of the investable market. However, rising concerns over U.S. weakening dollar returns are prompting investors, particularly in Europe, Japan, Sweden, and Australia, to explore alternatives like gold, Chinese tech, and emerging markets. Risk hedging via currency strategies is gaining traction as the dollar's depreciation erodes dollar-denominated returns. Peter reveals that China still offers plenty of cheap stocks, and with growing weight in emerging market funds, it's positioned to come out of the global trade war stronger, forming deeper ties with Russia, India, Africa, and even Latin America, while U.S. influence weakens. Meanwhile, U.S. tariffs, like the 50% duty on Indian goods, ultimately hurt American consumers and strain foreign partnerships. Commodities are set for a major boom as inflation rises and the dollar weakens. Energy, oil, natural gas, and agriculture all look cheap now, but demand will surge, especially from emerging markets that benefit from a weaker dollar. Instead of exporting to the U.S., these nations will increasingly produce and consume goods domestically, driving up demand for energy and resources. While this supports global growth, it also means higher commodity prices for Americans, many of whom will be priced out due to the declining dollar.
And so
I think there's still a lot of cheap stocks in China. We have some Chinese exposure in our funds, and especially in our emerging market fund where we're overweight China. But yeah, I mean, I think that China is going to come out of this, global trade war as the winner. I think that they're going to strengthen their trading relationships with the rest of the world. They're going to form better alliances with Russia, with India. This is going to be to the detriment of the U.S. And I think they're going to have stronger relationships in Africa, and maybe even in our own back door in South America. You might see that the Chinese gaining additional inroads in Latin America, because they're not going to be trading as much with the United States. It's not just that we shot ourselves in the foot. I mean, we're shooting ourselves in the head. Put 50% tariffs on India, 50%. Now, again, the tariffs aren't on India. They're on Americans who buy Indian goods. But it still is a problem for Indian companies that wanted to sell American goods, because now their goods are 50% more expensive if the Americans want to buy them. Yeah, well, first of all, if countries stop buying oil from Russia, it's just going to make oil more expensive, because if they have to buy it someplace else, you're just going to shift the demand, and we're going to end up paying higher prices. Ultimately, Russia is going to sell the oil anyway. It's going to get it out of the country. So it doesn't make any sense to put those sanctions on. And all it does is piss off people. Like it gives people another reason to get out of the dollar and get out of U.S. treasuries. I mean, countries don't like being sanctioned. They don't like being pushed around. I mean, we wouldn't like it either if some other country was doing it to us. America benefited from other countries using our currency. We got the seigniorage gain. We got artificially low interest rates too, and we got lower consumer prices. But we're pushing all that away. We're, biting the hands that have been feeding us. So it's generally not a good idea to do that. And they also, need to hedge against Bitcoin if they have some of that. That's the stupidity too, because a lot of people in America, instead of buying gold the way they're buying it in India or China, they've been buying fool's gold, aka Bitcoin. And that's been a problem, because when the Bitcoin bubble pops, a lot of these people who thought they were buying something like gold, they're going to find out that they weren't. So that's unfortunate, because Americans don't own enough gold, either because they own Bitcoin or they own nothing. But owning Bitcoin is basically like owning nothing, because that's all you got when you own Bitcoin is nothing. I think energy is cheap. Natural gas, oil is cheap. Agricultural commodities. I mean, I'm bullish pretty much on the whole complex of commodities. They're all going to be bid higher with all this inflation. And especially, as the dollar really tanks, if emerging markets are a main beneficiary of a weaker dollar, then they're going to consume a lot more commodities because, they're going to start consuming more of their own production. Instead of exporting stuff to America, they're going to build stuff and keep it. But I think there's going to be a lot more energy because they're going to produce a lot of things that are more energy and resource intensive when they're no longer just exporting trinkets to America. They're producing goods for their own consumers. So, we could see a real boom in commodities. And of course, this means that commodities are going to be a lot more expensive for Americans too. Just a lot of Americans won't be able to afford to buy them. They'll be priced out of the market.
Central banks record gold buying, weakening U.S. dollar returns, and the outperformance of foreign equities and commodities all point toward a structural shift in global capital flows. Gold and silver miners, alongside emerging markets, are increasingly attracting attention as U.S. assets lose appeal. With inflation, tariffs, and geopolitical realignments reshaping trade and reserve strategies, the next few years could mark a turning point where hard assets and non-U.S. markets take the lead. Could central bank demand alone be enough to push gold toward the $10,000 target? How will the shift of capital into emerging markets and commodities affect long-term U.S. economic influence? Share your thoughts in the comments below. We'd love to hear your perspective. Don't forget to subscribe for future updates, and if you found this content valuable, a thumbs up would be greatly appreciated. Thanks for being part of this journey with us.